to look at the tutorial questions related to Chapter 15, Contributed Capital. For this chapter, you can always go back to the recording on Google if you did not get a chance yet to watch the lecture. So today we're going to look at hopefully 5 tutorial questions. Let's see. Says more. Which door? The first one or the second one? I think as in the door is unlocked, the first door is unlocked or open? Oh, I probably, I rushed out last night, so maybe I did not close it. I think so. I don't know. So E15-1, par and no par stock issuance. Caswell Corporation is authorized to issue 10,000 shares of common stock. It sells 6,000 shares at $19 per share. We are required to record the sale of the stock given the following independent situations. 1, when the stock has a par value of $10. When the stock is no par, but the board of directors has assigned a stated value of 8, and the stock has no par and no stated value. So in the first one, when the shares have a par value of $10, we know that anything above par value, that will go to additional contributed capital on common stock, and the common stock account will be recorded at par. Since it is 6,000 shares at $10, then our common stock should have an increase of 60,000 being credited. But it was sold for $19, so that excess of $9 times the 6,000 should go to additional paid-in capital on common stock. 9 times 6,000, 54,000. And the full debit will go to cash. 6,000 times 19, which is the selling price for $114,000. So here, once you have anything above par value, then the excess must go to additional paid-in capital. The only thing that goes into the common stock account is at par. Then we look at when it's a no par, but it has a stated value by the board of directors. So here, even though it's a no par, the board has given a stated value, so we will treat that stated value of $8 as if it was the par value. So we debit cash for the full $114,000, and then the credit will be 6,000 times 8, which is 48,000. And the difference, 19 minus 8 is $11, so 11 times 6,000 will give you the additional paid-in capital of 66,000 credited. And in the next situation, when it has no par value or no stated value, then the entire amount that you sell the shares for will go to the common stock account. So since it has no par, no stated, then common stock will be credited for the full $114,000. So you can issue stock at par when it has a par value and when it has a no par. And in these cases, when it has a no par, the board of directors can give a stated value, or it simply stays at a no par stock. Any questions? In E15-3, we have sale of stock with bonds. E15-3. Pilsen Company issues 12% bonds with a face value of $10,000 and 600 shares of 10 par common stock in a combined sale, receiving the total proceeds of $23,000. Record the transaction for each independent assumption shown below. 1. The common stock has a current market value of $21 per share, and the market value of the bonds is not known. And 2. The common stock has a market value of $24.50 per share, and the bonds are currently selling at $98. So in the first instance, when the value of the bonds are not known, but we can fairly state the market value of the shares, then the bonds will be recorded at that market value. So first they said the entire proceeds that we received was $23,000. So we will debit our cash for the $23,000. Where would our credit go? We know that these are $10 par value shares. So 600 times 10 would give you 600 times 10 should give us 6,000. Oh, 600 times 10 will give you common stock of 6,000. Then we also know that the fair market value. So what do we have to do here? Calculate the aggregated fair market value. So the bonds in this question, $21, no, has a market value of 21. 600 times 21 will tell you the overall contributed capital on common stock. 600 times 21 is 12,600. But we would have already allocated from that 6,000, which would go to the common stock account. So the difference between both, the 12,600 minus the 6,000, is what we would have as additional paid-in capital of 6,600. Since the entire proceeds was 23,000, 23,000 minus what the shares represents, which is 12,600, will give us the book value of the bonds of 10,400. Since the bonds has a book value of 10,400 and the face value of the bond is 10,000, then it means the excess of 400 will go to premium on bonds payable. These bonds will issue above face value. So to go over the calculations again, we received $23,000 in cash. That cash that we received, we are given in exchange a bonds payable and also additional common stock. So the first thing we got to do is calculate, well, it already said that we do not know the market value of the bond, but we do have the market value of the shares. So the first thing we do, since it's 600 shares, 600 times the 21 gives us 12,600. Then we know that the common stock has a par value of 10. 10 times 600 will give you 6,000. That's the amount that goes to common stock. So out of that 12,600, we are allocating 6,000 to common stock. So we know that the difference of 6,600 is our additional paid-in capital. So out of that 23,000 we received, 12,600 relates to the bond, which means to the common shares, which means the difference now relates to the bonds. That difference is 10,400, but the bond itself has a face value of 10,000. So since the bond has a face value of 10, it means that the excess 400 is a premium on bond payable. So here you would debit cash for the 23,000, and we would credit premium on bonds payable for. Bonds payable for 10,000, common stock at par 6,000, additional paid-in capital 6,000. In the second situation here, it says the bonds, the common stock has a market value of $24.50 and the bonds are selling at 98%. So the debit will remain the same, $23,000. If the bond is selling at 98, it means that we issued at a discount because it's below the 100. So there is a 2% discount. We know that the face value of the bond is $10,000. So 2% of 10,000 is what?
200.
200. So there's a 200 discount. However, we now have to look at the aggregated fair value because the 23,000 represented a bulk purchase. Therefore, take the common stock, which is the 600 shares, times 24.50, and that will give us 14,000. Find 98% of the bond, which is 9,800. When we add the 14,098 together, we get 24,500. That 24,500, what portion belongs to the common stock and what portion belongs to the bonds? So we take the 23,000 cash received times 14,700, which is the fair value of the stock, all divided by 24,500. So that represents 13,800 for common stock. Then we do the calculation for bonds payable. The cash received, 23,000, times 9,800 divided by 24,500. That gives you the 9,200. So we now go back to the journal entry. If the bond has a face value of 10,000, but the proceeds that we receive represents 9,200, that's the amount that the bond represents, then the difference between 10,000 and 9,200 is an 800 discount. The bonds payable will be credited at its face value, 10,000. Common stock, 600 shares times $10 is 6,000. 6,000 from 1,380 leaves 7,800 for the additional paid-in capital. Any questions? Any questions? E1515. Treasury stock cost method. On January 1st, Lorraine Corporation had 2,000 shares of $5 per common stock, authorized and outstanding. These shares were originally issued at a price of $26 per share. In addition, 500 shares of 50 per preferred stock was outstanding. These were issued at a price of $75 per share. During the year, the following stock transactions occurred: March 3rd, 7th, April 27th, July 10th, October 15th. We are going to prepare the journal entry for each date, assuming that it uses the cost method. On March 3rd, Lorraine reacquired 100 shares of its own common stock at a cost of $24. So they issued stock and now they're taking back stock. Those stock that they're taking back, once you're reclaiming any type of shares, it goes to treasury stock. They are reclaiming 100 shares at $24, so we simply debit treasury stock 24 times 100 for $2,400, and we credit the cash for the same because they're paying for it. On April 27th, it sold 25 shares of the common stock acquired on March 3rd for $33 per share. So of those 100 shares that were reclaimed, it is now selling 25 at 3,300. So what will it receive in cash? 33 times 25, which is 825. How many of those shares are they selling over? They're selling over 25. And when you reclaimed it at 24. So 24 times 25, which is 600, represents the reduction in treasury stock because you're selling them over. And the difference between the 825 and the 600 goes to additional paid-in capital from treasury stock for 220. Any questions? July 10th. It sold 25 shares of common stock acquired on March 3rd for $22 per share. So from, again, that 100 common treasury stock, on July 10th, it is selling an additional 25, but at this time, $22 per share. 22 times 25 is $550. Treasury stock, when you acquired them, reacquired, you got it at 24. So 24 times 25 is 600. So here we see the amount that you're selling it for is less than the amount you paid to reclaim it, which is $2. So that 2 times 25 is 50. That is going to reduce the additional paid-in capital from treasury stock. In other words, it's like a discount, but when we're dealing with treasury stock, that discount reduction affects additional paid-in capital from treasury stock. October 12th. It retired the remaining shares on March 3rd. So they reclaimed 100, sold 25, sold another 25, so the remaining is 50. And that 50 shares from the treasury stock is saying that they're retiring them. So what do? 50 times $5 par, because those treasury stock was once common stock. And those common stock had a par value of $5. So when you are retiring treasury stock, it will be a reduction to the equity account common stock. So what are we debiting common stock for? Since it's 50 shares we are retiring and the par value is 5, 50 times 5, $250. Then it will also reduce the additional paid-in capital and common stock. When you got those shares, they were issued to you, or you issued them at $26, which is $21 above par value. Par value is 5. So those stock came with additional capital. If you're getting rid of the stock, you have to get rid of its additional. So $21 times 50 is a reduction in additional paid-in capital on common stock, $10.50. Then you are going to reduce treasury stock. When we got the treasury stock, we debited. So since we are reducing it, we must credit. How much did we get them for? We got them back at 24, so 24 times 50 will give us 1,200. But those shares also had its contributed capital because we got them for 24. 24?
Yes.
We got them for 24. So when we look at the 50 times, how much was it? 24. 26. So 50 times 2, because we got them back at 24, but when we bought them for 26. 26 minus 24 leaves 2. 2 times 50 is 100. So here you're seeing what happens when you reclaim treasury stock. Once you reacquire any shares, it's a debit to treasury stock. It's a contra account that reduces common stock. Whenever you issue or we issue any treasury stock that we have reacquired, everything will impact treasury stock. At what time does treasury stock reduces its common stock? If you decide to retire, it means you have no interest in selling them in the future, we're done with it, so you retire them against the common stock. Any questions?
Just go over that I got lost with the 21, but after you found 26, I realized it's the 5 from the 26 that you did the 21 times the 50. But then when we came up on the treasury stock.
Go over which one? The October 12th?
Yes, please.
So on October 12th, the remaining 50 shares of treasury stock that you reclaim, you're retiring. It means you don't want them anymore. So you have no intention to keep or sell. Whenever you're retiring treasury stock, you have to go back to the original transaction of when you issued those stocks. So when you sold those stocks to me, they would have been sold at $26, but the par value is 5. You then came back and you bought them back from me, and you bought it back at 24. So you see where the 26 and the 24 comes in. So because we no longer want the treasury stock, we have to reduce common stock because these stocks are no longer out there and we have no intention to sell them. So we go back to the original transaction that happened when you would have sold them to me. When you would have sold them to me, you would have credited common stock 50 times 5 at the par value. But since we're getting rid of it, we have to debit it by reducing the 5 times 50. But in the same breath, those common stock, when you sold them to me, I gave you more money than par. So we had an increase in additional paid-in capital. If we're getting rid of the stock, we'll have to get rid of the associated paid-in capital. So how much did you sell it to me for? 21. So 21 times the 50 is what we're getting rid of from additional paid-in capital, which is 1050. Since we're getting rid of the treasury stock, when you took them back from me, you would have debited. But now you no longer want the remainder. So since you're getting rid of it, you must credit. How many remains? At first it was 100, then you sold 25, then you sold another 25. So 50 is remaining. That 50 that you no longer want must reduce the treasury stock account by crediting for 24 times 50, 1200. But there was what? There was additional paid-in capital that came in with it. You sold it at the time for 26, you reclaimed it at 24, so there's that $2 extra. 2 times 50 is 100, and that is the further reduction for additional paid-in capital on treasury stock. Any questions? The next question is P15-9. P15-9 is a comprehensive question that covers 3 learning objectives, 3, 6, and 7. Young Corporation has been operating successfully for years. It is authorized to issue 24,000 shares of no-par common stock and 6,000 shares of 8% 100 par preferred stock. The contributed capital section on its balance sheet at the beginning of 2019 is as follows. 8% preferred stock at 100 par, 190,000. Common stock, no par value, 184,000. Additional paid-in capital on preferred stock, 15,200. Part A. A shareholder has raised the following question. What is the legal capital of the corporation? At what average price per share has the preferred stock been issued? How many shares of common stock have been issued? The common stock has been issued at an average price of $23 per share. So starting with the first question, what is our legal capital? It says we have 190,000 preferred stock, and we also have 184,000 of common stock. So our legal capital is the sum of both, 374,000. So what is the average price for the issuance of the preferred stock? Here, we started with 190,000, but during the year, hold on. Oh, we started with 190,000. But I believe during the year, we issued this is still at January 1st. So we started with 190,000 of preferred stock in its equity account. But also those stock was issued at a premium, so we had additional paid-in capital of 15,200. So we have to add both of them to see what was the overall proceeds from issuing those common preferred stock. And then we are going to divide it by how many preferred shares do we have out there. Now it said that if you have 190,000 shares and you divide that by the par value of 100, that should represent 1,900 shares. So therefore, 190,000 the equity, plus the additional paid-in capital on preferred of 15,200, divided by the total shares issued, which is 1,900, will give you the average price of $108. How did we get the 1,900? We went straight to the equity account and it had 190,000, and we know the par value is 100. So 190,000 divided by 100, that represents 1,900 shares. And then it asks, what is the number of common stock that we have issued? Since it's 184,000, par value, it says that the average price is 23 because these are no par value common stock. But the average price is 23. 184,000 divided by 23. This would represent 8,000 shares. Any questions? We're now asked to prepare the journal entries to record the transaction in Part B. So we have a couple dates, and for each one we'll do the journal entry starting with March 2nd. Issued 350 shares of 8% preferred stock at 122 per share. It means that the shares were issued at a premium because the par value is 10. Therefore, 122 times 350 is 42,700 to be debited to cash. What goes to put a preferred stock equity account? 100 times 350, which is 35,000. Therefore, additional capital on common stock is 22 times 350, which should give us 7,700. April 5th. On April 5th, we sold 900 shares of common stock for $34 per share. So here we're selling common stock. Remember, they have no par value and there's no stated value either. Once there's no par value and no stated value, the entire amount will go to common stock. So 34 times 900 is 30,006, being credited, debited to cash, and being credited common stock no par, 900 shares for the same 30,006. If there is no par value and no stated value, whatever you sell the shares for, the entire amount goes to the equity account. In the same April 13th, we issued 400 shares of common stock in exchange for land. The stock is currently selling at $33. So here, we don't have a fair value for land, we have the fair value for the stock, so the land will be valued for the same amount as the stock. So since these are no-par shares, 400 times the 33 in which they're currently traded for is 13,002. That's the amount that land will be debited for. And the credit for the entire amount, common stock, no par, 400 shares. June 1st. Reacquired 500 shares of common stock at 36 per share. The company currently uses the cost method to account for the treasury stock. So what do we have? They are being reacquired for 3,600, 500 times 36 gives us 18,000. When it's the cost method and you're reacquiring stock, that amount goes to a debit to treasury stock, 18,000. And you credit cash for the amount that you paid out, which is the same 18,000. Then on October 19th, you issued for 27,000, so you received 27,000, a combination of 500 shares of common stock, 100 shares of preferred stock. The common and preferred stock are currently selling at $35 and $125 respectively. So here, what do we have? We have the receipt of cash for 27,000. But what must we do? Take the aggregated amount of the fair market value, starting with common stock. How many common stock did we issue? 500. What is the fair market value? $35. 500 times 35 is the numerator. What's the denominator? The overall fair value of both common stock and preferred stock. So 500 times 35 plus, it was 100 preferred shares with a market value of 125 gives you the denominator. When you work it out, you will get 15,750. We do the same for preferred stock. What was the amount of cash received? 27,000. What is the fair value of the preferred stock? 100 shares times 125 divided by the overall fair value of both common and preferred. That will give you 11,250. When you add both of them up, it comes back to the cash received of 27,000. So we now go to this. Since it's a no par, the entire 15,750 will go to common stock. What do we do about the preferred stock? The preferred stock has a par value of 100. Therefore, 100 times 500, I believe will give us, no, how many shares did we issue? Not 5. It's 100 shares? Yes. No. How many shares did we issue? We issued 100 shares. Page gone. We issued 100 shares of preferred stock. And the preferred stock, at this case, had a par value of 100. So 100 shares times $100 is 10,000. But we know that the overall contribution of preferred stock is 11,250. Therefore, 11,250 minus 10,000 gives us the difference that will go to additional paid-in capital on preferred stock. November 16th. On November 16th, we reissued the 500 shares of treasury stock at 38. Those treasury stock on June 1st that we reclaimed, we are reissuing them at $38 per share. Since this is, so 38 times 500, 19,000. But we reclaimed them at what? $36. So 36 times 500 is 18,000. That's the amount that we're going to reduce the treasury stock by. So therefore, the difference between 38 and 36 is $2. So 2 times 500 is 1,000. That's the amount we're going to reduce the additional paid-in capital from treasury stock. December 31st. Diluted on $8 per share dividend, all preferred stock outstanding, and $2 per share dividend on all common stock to this date. Debit the retained earnings and credit cash for each dividend. So when it comes to dividends, we know that dividends reduces retained earnings. So how do we get the amount? First, we need to know how many total common stock do we have out there. We started with 8,000 on January 1st when we did the calculation. We issued another 900 shares on April 5th. Then on the 13th, we issued another 400 shares on April 13th. And then we issued another 500 shares on October 19th. When you add all of that, then times it by the dividends of $2, overall dividends on common stock is 19,600. So we're going to debit the retained earnings for 19,600 and credit cash 19,600. Preferred stock. How many preferred stocks do we have out there? We started at 1,900, we issued 350 at some point, and we issued another 100. We know that it is 8% of the 100 par value, so therefore, the total amount of shares times the percent of dividend declared, which is 8%, times the par value. When you multiply it, dividends on preferred shares, 18,008. Debit retained earnings for 18,008, credit cash 18,008. And the third one, prepare the contribution capital section as at December 31st, 2016. I believe this is a typo, it should have been 2019 because we started January 1st, 2019. So it should have been 19, not 16. So at the end of the year, what do we have? We're going to have 8% preferred stock, 100 par, 6,000 shares authorized, and to date, we have issued 2350, and that has a total amount of 235,000. All we're doing is adding up all of the equity in preferred stock, what we started with, and the 2 transactions that happened during the year. Common stock, no par. We are authorized to issue 24,000, and to date, we have issued an outstanding 9,800. So that 9,800, what is the value? The 18,004 we started with, plus the 3 transactions that we would have done earlier during the year added. That will give you 243,550. C, additional paid-in capital on preferred stock, 15,002, what we started with, and from the journal entries, anything that had additional paid-in capital and preferred stock would be added, which gives us 24,150. Additional paid-in capital from treasury stock, we had 1 journal entry of 1,000. So therefore, when we add all of them, contributed capital 503,700. Any questions? Any questions? So the final tutorial question, which is P15, is it 1515 or 1513?
15.
P1515 deals with reconstruction of journal entries. At the end of the first year of operation, Leo's company lists the following accounts and ending balances related to stock: cash from stock and dividends paid, subscription receivable on common stock, subscription receivable on preferred stock, equipment, preferred stock subscribed, how many do you have in the actual equity of preferred stock, the additional paid in capital on preferred stock, common stock subscribed, common stock at a stated value, additional paid in capital on common stock, and the retained earnings. They've said what happened during the first year's operation 1 to 5. We are required, on the basis of the preceding information, reconstruct all the journal entries that the company made to record the stock transactions, net income, and dividends. It may be helpful to begin using T accounts and enter the ending balances. Starting with the first one. You have subscription contracts that were entered into for common stock of $9 per share, preferred stock at $112 per share. Common stock subscription require a $2 per share down payment. Preferred stock subscriptions require no down payment. Shares, either common or preferred, were issued to subscribers upon full payment. So what do we have here? Common stock. Stated 95. Am I looking at the right exercise here?
Yes, that's what it said. No, exactly what I'm looking at this.
Oh, they're doing journal entries for
Reconstruct
the table
all-
at the top.
Reconstruct journal entries.
Reconstruct all journal entries that the company made to record the stock transactions. So we have equipment of 39,000, of 69,000. So they did say to start with the T accounts.
Yeah, it's in P13. What did I say? Miss?
Hmm?
It's in P13?
What are we doing, 15 or 13?
It's in 13.
I don't know how some people say 15. According to the schedule I have.
It's 13?
Yeah.
I have 15.
Let me
but
check mine again. I have it here.
I'll go back to 15 though because...
Oh, it's 13 actually.
Oh, it's 13. Yeah. P1513. So we have a list of partial accounts and their ending balances. And we have 3 additional information.
Okay, so that
Prepare the contributed capital section of the balance sheet. Include appropriate headed notes for common stock and preferred stock. So at the end of the year, we have our balances. The additional information, it says, common stock is no par, with a stated value of $10 per share. 90,000 shares were authorized, but 50,000 are issued and outstanding, and 6,000 have been subscribed. So starting with the common stock, because I'm going to start with common stock. Common stock, when you're putting it in the balance sheet, it has to have common stock. The stated or par value, it says the stated amount is $10. You have 90,000 shares authorized, that's the entire amount you can issue, that's the maximum you can sell. Out of that 90,000, you have already issued 50,000, so that's what it wants to see. 50,000 times the stated gives us the 500,000. Common stock again. We have subscribed 6,000 common stock at $28 per shares. It simply means that we have sold 6,000, but whoever we sold them to have not paid off for them. Once it's not paid off, it goes to common stock subscribed. So 6,000 shares times the subscription price of $28 gives us that gives us 60,000. 28 times 6 is 60,000. Because I got that it's supposed to get 10,000 though. At 10. Because 6,000 times 10, which is the stated value, is what gives us the 60,000. Right?
60,000 times 10.
Times 10. Those same common stock, we're going to have additional paid-in capital. What is the additional paid-in capital on that? It says, additional paid-in capital on common stock is 460,000, so we just put it back. Additional paid-in capital, common stock 460,000. Then we have preferred stock. According to this, the preferred stock has a $50 per value. You are authorized to sell up to 8,000 and you've already issued 6,000. So preferred stock at $50 per value. There's more information. 6,000 shares are outstanding. 700 shares have been subscribed at a price of $70 per share. Each share is cumulative, is convertible into 5 shares of common stock, and pays a 7% dividend. So here we have preferred stock at $50 per, in bracket the dividends percentage of 7. It is also cumulative, and also each one of these can eventually convert into 5 shares of common stock. Overall, we are authorized to issue 8,000, but so far we have issued 6,000. So when you go to a balance sheet, you're supposed to see everything that relates to the stock. 50,000 times $50 times 6,000 is 300,000. We also have preferred stock subscribed, 700 shares. 700 times 50 is 35,000, but the subscription price is $70. We have additional paid-in capital on preferred stock from the table of 112,000, and we also have additional paid-in capital from treasury stock 4,000. Gives us a total of contributed capital 1,491,000. The bonds payable does not go to contributed capital, that goes to liability. Long-term investments in common stock, that goes to our assets section. Premium on bonds payable is the liability section. Unrealized increased value of securities available for sale, comprehensive income section, and common stock warrants, 20,000, also goes to the income statement. So the only thing from this, from the summary here, that will go towards the contributed and retained earnings is not contributed capital. Retained earnings is a stockholders' equity component. So after contributed capital, then you would see retained earnings. Any questions? So the information on the bonds payable is null and void because of course bonds is not contributed capital, that's a liability. Any questions?
What are the long-term investment in stock?
It means that you have invested in another company that's a non-current asset.
Miss, what if I told you this is the wrong one? I should be 15.
It should have been 15.
I think so. This is the previous year.
Which previous year?
23, 24.
But what's in the current shell? You gone in the other?
No, that's what I'm saying. This is 13 is from the previous year. 15 is this year. We're looking. You understand what I mean? like from my,
So why are you back and forth between two pages?
no, I know, right?
Please sign where your name is on the member return column.
Yeah.
Can I what?
Let me check again. You understand? This is the one, yeah. That one is from the previous year.
But you're the only one in here that have access to the previous year.
Well, I'm not sure how she got that either. She might have gotten it wrong. So let me go again. Let me see. 24 courses, okay. Welcome.
In the question you mentioned,
Hold on.
that something was at 98.
It's right, good.
The bonds were issued at 98, which means they were issued
That's
at
right.
a discount
Plus 98.
percent.
Huh?
Oh.
It was right, yes, sorry. Good.
Was that like a typo?
No,
So they can just say 90 because
that's
it
how,
was
that's the
7%.
language, yes.
Wow.
Go back to bonds payable section, chapter.
Yes.
So that brings us to the end of the tutorial related to this chapter. I would have already said what are the learning objectives that are going through the midterm relating to this chapter. I will set some questions for revision, but you're not limited to those questions. Please go over them and more questions once your time permits. If we don't have any questions, once you've signed the register, you're free to go.
You said it before.
Say what? No, why did I say it? It's on Moodle. It's been on Moodle.
Yeah.